Crypto Hotep here with another investing video. We are on week 56 of the family portfolio and dividends tracker. Now, if you're unfamiliar with these videos, feel free to go to my channel, go to week number 1, where I talk about my whole methodology and the reason why I'm doing what I'm doing. Basically, I gave my family just a list of stocks from my research to invest in, mostly dividend stocks. And they picked the companies that most produced a valuable income to them or a valuable reason to pick them. And then I proceeded to use M1 Finance to create our major portfolio. And with M1 Finance, you can create sub-portfolios within it. So every one of my family members has a sub-portfolio with his or her own stocks of their choosing. And every week we go through this portfolio and we discuss market news, trends, how we're feeling in the markets, any buys, not any sells really, because we're not really selling stocks, and then just documenting our overall investment journey. So if you like this video, feel free to like, subscribe, comment, let me know what you think. And as always, this is not financial advice at all. With that being said, we can go into the video. But before we go to week 56, we go back to week 55 and we see where we were at. So in week 55, we were at a balance of 1984.15 and the market was dipping because of those tariffs that we mentioned in the previous video, in this video, week 55. We had dividends earned of $6.28, market gain of a negative $154.06 with a money weighted rate of return year to date of a negative 7.84%. So this week, we are looking at even the dip has dipped even more. So our balance has decreased even more, 1938.14, dividends earned of $6.39, market gain of a negative $213.73, and a money weighted rate of return of a negative 10.88%. So what is going on? Again, one word, tariffs. So China and US have been going back and forth on tariffs. There have been countries that have proceeded to negotiate with Trump and the US on their tariffs, which has been very bullish. However, there's been high headlines with China and the US literally going back and forth. One country doing a tariff larger than the other and back and forth and back and forth. Markets don't like that. Markets don't like uncertainty. And this is the major reason into these dips here. But again, it's the dips and it's these like bearish market conditions that generate wealth in the long term. And that's why you buy those solid companies for these reasons alone, so you can buy those solid companies at cheaper prices. So if we go into the activity here, we'll see what's happened between this week and last week. So let's see what we have here. So between this week and last week, one thing that we did with our kids, the youngest and our middle, was we had to sell off Nintendo, as we talked about in the previous video, because it's only traded on the Tokyo Stock Exchange and M1 Finance only put it in liquidation mode. So what the kids decided is they were going to sell off Nintendo, but then also use or transfer that money from the Nintendo sale into Sony because of PlayStation. So what we did, or what M1 Finance did, is they sold off Nintendo and then they proceeded to use the bulk of that with Sony, but then they also kind of rebalanced their portfolio so the allocation percentages looked okay here. So that's the reason for these multiple buys here. Okay. And then we also had one buy here of just McCormick, the McCormick stock, which is in my portfolio. And then we had our regular deposit of $15 here, and we had 5 buys of Google. We stocked up on Google a lot. Apple, stocked up on Apple a lot. Tesla, and then again, we bought some more Sony here. So if we go to the portfolio, we always go bottom to top. Unfortunately, my wife's at the bottom again this week, but you know, we are trekking we're trekking better than what we were. We are negative though. So the balance is under 200 at 191.86, money weighted rate of return of a negative 1.96%, market gain of a negative $3.51, dividends earned of $2.46. So basically the key premise on this is Google is the one who is kind of right now bearing the load and bringing that portfolio down. That's fine. We're going to be buying Google on the dips all day long and twice on Sunday. Google is at a fantastic price. Again, this is not financial advice, but the fundamentals of Google haven't changed. The stock price has changed. That's all. Tesla, again, Tesla's down over 37%, and then Pepsi is down over almost 5% here. But again, Celsius, which we've been buying consistently, Celsius is up over 44.5% here. So, not too mad about this portfolio at all. And, it's just a matter of time before everything starts to turn around. Now, if we go to our middle stock, our middle is a bounce over 200 at 203.61. Money weighted rate of return of a negative 14.5%. Market gain of a negative $29.31. And then dividends earned of 60 cents. So it's a mixed bag here, right? So Costco is still doing what Costco does. Whether we're in a bearish or bullish market, Costco has always been up and to the right forever in terms of price. They're up 5% here. Sony, what we just bought, is up over 9.5%. Google, because remember we got Google at a better price here in our middle portfolio than we did with my wife's portfolio, is actually up in the positive over 6.5%. Tesla is continuing the downtrend at 37%. Starbucks continuing the downtrend over 9%. Target, I believe Target is also a gem right now, down over 33, almost 34%, but I think Target is a very good buy. It's a very good dividend stock, long-standing company, and I think it just has a lot of FUD with the whole DEI thing going on. But I think this is just a season for Target. It's just a down season for Target, and I think in the long run, it's always trended well. Amazon, again, another player that's discounted. Right now, it's down over 19% in our middle portfolio, but again, a tech company that's going to be here for years to come, and the fundamentals look great. Let's see what we have here for our youngest. Our youngest is over $200 in the balance at $241.11. Dividends earned of 33 cents. Market gain of a negative $24.24 with a negative 10.47 market weight of return year to date. Tesla, again, negative 37% for Tesla. Apple, negative 24, almost 25% for Apple, which is fine. But Sony, as we just spoke about with our middle, up over 10% on Apple, right? Costco, again, what we talked about, up almost 10% on Costco, and then Starbucks down over 10% on Starbucks here. Now let's go to mine. We go to mine. Year to date balance at $631.47. Dividends earned of $3.63. Market gain of a negative $52.41. Money weighted rate of return of a negative 7.63%. So if we look at mine, see a red, right? And technology is basically the main player in this and the reason for that. So technology sectors down over 21.34%, but guess what? We're putting our money in mostly technology because they're at a cheaper price right now. Consumer and staples also down over 4%. Industrials and energy, which is surprising, is now just peaked down over the red at negative 0.39%. So, but the common players, Duke, Waste Management, Cintas, Deere, all these are in the green here. Exxon did take a dip, and Chevron did take a dip with the oil prices dipping below because of those tariff scare. This negatively affected ExxonMobil and Chevron. Again, uncertainty with the markets. Oil markets are not shielded from that. And then Union Pacific and Caterpillar. I believe Caterpillar is at a fantastic buy right now. We are down over 21%, but I would be buying some more Caterpillar as well. From the finance sector, down over 6% on the finance sector. Real estate down over 7% on the real estate. And then pharmaceutical down over 7.5% on pharmaceutical. J&J has found its footing. We're just waiting on Pfizer to find its footing and its bottom right now. So down over 18% year to date on Pfizer. But again, I'm not really worried about Pfizer currently. And then honestly, the growth in the meme stocks are only down over 6.5%. Not really worried about those. All in all, money weighted rate of return a negative 7.63%. As of right now, other than my wife, that is the lowest negative weighted rate of return out of all the portfolios here. And, I'm pretty comfortable with my positions. Again, these are the areas and these are the times in the market where wealth is generated, and you have to be able to stomach these dips. We aren't doing day trading with this portfolio or with M1 Finance. M1 Finance is not a platform to do that. It's more of passive investing and long-term investing. So when you long-term invest, you're not getting in and getting out of positions quickly. You're just obviously doing your research on those companies, feeling good about the company's mission, the leadership, and you're having a long-term projection for that company. And that's why, mainly we're just buying these companies because we've done the research. We feel good about the long-term vision of that company, and we know that the price will go up, in time. It may not go up overnight, but it will go up in time. And with that being said, we'll go to our Otis. Our Otis has a balance of $6.70 and 10 cents. Dividends earned of $1.37. Market gain of a negative 104.25, with a money weighted rate of return year to date of negative 15%. Again, the common players here: Apple down over 25% for Apple, Costco up over 4% for Costco, and then McDonald's up over 6% with McDonald's. McDonald's is a very interesting one. With McDonald's, I will say, with the recession scares and the talks that are going on, this makes a lot of sense. Why does this make sense? Well, because McDonald's offers a cheaper food alternative for people, less money that people have, less capital. People more than likely will be turning more to McDonald's for their food items. Okay. And with that being said, we have Tesla again bringing up the rear at 36.31%. The overall portfolio is at a negative 10.88%, market gain of a negative $213.73, dividends earned of $6.39, and capping week 56 off at a balance of 1938.14. My thoughts is, we're investing we're investing for the long term. That's the biggest thing. You can see these dips here in this market volatility. This market volatility for this week has been crazy. And you have to have the stomach for it. And you have to be able to zoom out. Yeah, this is a massive dip here, but we've come a long way since we started these videos here. Look at this projection that we've had, right? So this is just a small blip in the overall investment journey. And if you can stomach that, you're going to do great. Now, if you're going to rely on meme stocks and, smaller, lower caps and companies that really don't have financial future, then yeah, I'd be very nervous. Or if you're going to be relying on margin and using increased leverage, yes, I would be very nervous right now. But, if you've done your research on your companies, if you feel great with your companies that you've selected, and if they're legitimate companies, then this is just a small blip in the road. So with that being said, guys, we will cut this video. As always, hope this video is helpful. Feel free to like, subscribe, comment, let me know what you think. And as always, thank you and happy investing.